everybody. Hope everybody's doing well. Good evening and welcome to our Unbeatable Mortgage market update for FOMC August. So Jerome Powell recently has been dropping quite a few hints in his latest FOMC update, and we're gonna have a presentation about it. We're gonna talk to you guys about what is going on, and together with me today, we will have one of our consultants that's here to say hi and maybe share a little bit about his experience handling cash flow from companies, MNCs, for more than 30 years. Jam, please come and say hi.
Hi.
All right. Thank you. Okay, so everybody, hope you guys had a nice dinner. If anybody can hear me, you can type in the group in the chat and say hello, so that I know that we are talking to people and not nobody. But either way, this is our first time. Be kind to us. Let's go. All right. So that's it. Today, let me introduce ourselves. I am Ethan. I am running Unbeatable Mortgage. We are here. We specialize in home loans in Singapore. We've got SAMP accreditation and whatsoever. But more importantly, today we want to tell you that we have a proven framework, and today we are going to talk specifically about interest rates. Okay, we have strategy, structure, and rate. Strategy and structure is something that's more personal, so we'll leave it for our consultation. However, interest rate is something that affects everybody. And that being said, I think today we're gonna zoom in more towards that. And that's it. The disclosures I will have to once again let you guys know. All right. So this video contains a lot of forward-looking statements. Anything that is data is something that has already happened. The rest of it is likely for forward-looking statements, which please take with a pinch of salt. This is not financial advice, and that's it. Shem, can I ask? All right, what is a good debt? What is bad debt? Let us know about your experience.
Well, this is how I would start with the question. Is cash the king or is debt the king? Because if you look at this statement here from Robert Kiyosaki, he says, good debt is a powerful tool, but bad debt can kill you. Well, from my point of view, this is the dichotomy of cash flow. We all love cash flow, but sometimes debt is good. And if you follow Robert Kiyosaki, he will tell you why debt is good. And we can get a little bit more into debt later on if we have the time. But for an initial discussion, I will just say that at all times, cash is king. And because as long as you're debt-free, you can do a lot of things with what you want to do with your life.
Absolutely, absolutely. And I think in this circumstance, right, that can be very, very powerful if it is an instrument to be able to offload inflation, if it is an instrument for you to be able to own the property. And when we are talking about that, you should always consider inflation, yeah.
Exactly. If you look at this statement again, what Robert Kiyosaki is saying, when you see him, he's holding a piece of paper. That's a US dollar note. He's basically, that's just a piece of paper. It means nothing to him. And therefore, in this particular podcast that Robert Kiyosaki did, he's saying, use other people's money to make money. And when you use other people's money to make money, that's when you have the cash, and cash becomes king. So it's good debt to become a powerful tool to generate cash. And after that, you have cash becomes king.
Absolutely. So with that being said, let's talk about mortgage. Okay, so mortgage is one of the best instruments. I may be biased because Unbeatable Mortgage and what have you, but it allows you to take a loan up to 75%, and as you pay down your loan, right, the mortgage gets reduced over time. When your property appreciates and your mortgage gets paid down, what happens is that you become a millionaire in the most boring way possible. This is wonderful, and this gives like the mortgage in Singapore actually is one of the cheaper ones because it's the only loan that can be paid back using CPF OA. And today, right, outside of letting you guys know what is the best rates in the market, we also try our best to help you avoid thereafter rates. Shem, tell us a little bit about thereafter rates. Why are they good for a certain reason? Are they like if you want to sell your house, maybe this might be good, but for other reasons, like do you want to be in thereafter rates?
No, thereafter it sucks because if you look at this, chart here, you just have to read the first one,
Mm,
first red box. It says 3 months SORA plus 1%. Do you know what is
mm.
3 months SORA today? It's about
What is it?
3.6%. Three point six
Wow.
percent, right? And 3.6 plus one is 4.6%. That is
Is
a
it
very high interest rate to pay
very
for thereafter rates. Because guess what? If you watch CNBC yesterday,
mm,
last night the yield for the first time dropped below 4%. U.S. Treasury yields. So which means that if you're paying 4.6%, you're paying more than the U.S. Treasury yield.
mm. And if you go for the fixed,
Well, the fix is different. Look at the fix. You fix it at
mm,
2.9%, and with and you're in a safe zone. You're in a comfort zone. Now that's for 300K loan. If you look at this table, right? But let's say you
mm,
go over a million, it's 2.83%. So the more
mm.
you borrow, the lower is the interest rate, and therefore you are assured of an interest expense that doesn't fluctuate, and with that you will save a lot of interest expense.
But Shem, at this point of time, a lot of people are saying, "Hey, interest rates are going to fall. Why are we doing the contrarian thing of getting a locked-in rate while interest rates are falling? Should we hold it until maybe when things get better, or what do you suggest?"
I I have two viewpoints to this. The first viewpoint is that what's the alternative? The alternative is to have a SORA plus, right, which is the
Mm,
fluctuating, right? And if
mm.
SORA plus gives you 4.6%, it makes no sense to go for 4.6 when the fix is 2.9. All right. Tell me, Ethan, how much will SORA fall? If it's
Okay.
3.6 right now, let's say even if it falls, let's say it falls to 3. All right,
Mm,
let's say if it falls to 2.5. Let's say it falls to 2.5, Sora. Okay? 2.5 plus 1 gives you 3.5.
mm.
You're still worse off than a fix of 2.9, right? So that's the
Correct.
first reason. Second reason why I think a fixed rate for the first 2 years is good is because a fixed rate, there are some banks that offers free conversion after 1 year.
Correct.
And if you happen to sign up with a bank to get a
Mm.
mortgage loan that gives you a free conversion after 12 months, then you're in fact in tandem with the market. The market interest rate falls, your fixed rate falls as well.
Right. And I think what you said was very correct. And when we are actually contemplating the numbers, actually when we are looking at what's going on with the SORA rate, like what you said, the 3 months average right now, it is at 3.63. And then the 1 month SORA is 3.5, SORA is at 3.53, thereabout. What is the difference between maybe a $1 million loan? From the numbers before, we draw up a table, and this is why we think that this is important, and this is why we care so much. This is why we do the research that you're about to see later. All right. So for $1 million, right, the difference of the interest rates, let's just say if we choose between fixed and floating and we choose wrong. Okay, let's just say if we choose wrong, we are actually paying a lot more for interest. And if you can see at the bottom right corner, let me try to highlight over here. You can see, oh goodness, 1 second, and there we go. Okay, and if you look at the bottom right corner over here, you can see that the amount of interest you'll be paying more is about $23,000. But if interest rate goes down, maybe you're looking at $20,000 more. So our job is to be able to help our clients save as much money as possible. And when our clients get rich, we get rich together with them. So that gives us a nice jumping point to our research in Unbeatable. All right. So I'm the economist. What we do is we look at the market to be able to tell you exactly which is going to be likely the better options, which is likely to be the rate that we can actually hold on to. All right, and it starts with looking at the MAS policy. Okay, while looking at the MAS policy, we see Singapore typically don't control domestic interest rate. We follow the market, and it is typically below the US interest rates. All right, so Shem, why are we having our interest rate so closely tied to the US? Can you explain?
Well, because from a Singapore point of view, you don't want too much fluctuations. You want to be close to when Jerome Powell says, "This is my interest rate that I'm going to declare for, that I'm going to cut to, and whatever the percent is." You want to go in tandem with that. You don't want to go oppose that. You don't want to go too far above that or too far below that. You just want to dance in tango with the U.S. Treasury rates, and by doing that, you are now in tandem with the world economics. You will not get the seismic effects of exchange rate of interest rate changes that may occur if you had adopted a policy that is otherwise to what it's doing today.
That is correct. So a part of that is also with the economics of interest rates and how certain countries will benefit from having higher interest rates, and certain economies will benefit from having lower interest rate. As you know, Singapore, we are middlemen, and most of the settlement is still in US dollars. So what we do is we look at this, and of course, we don't believe the government by 100%. What I like to do is I like to lean on my data. So in Unbeatable, we've actually drawn up data from the last 19 years and found that there has been a 94.47% correlation. I am required to say that these past performances are not indicative of future results, but 94.47 is 94.47, yes. So let's look at the latest FOMC. All right. So the latest FOMC, the one that Jerome Powell just recently dropped on the 1st of August in our time. We want to see what happened and what's going on. All right. Which is they decide to hold the interest rates at 5.33%. They did say that cuts could be on the table. The word specifically that Jerome Powell used was could be on the table. And one does not simply reduce interest rates, because if you reduce interest rates too quickly, what happens is inflation will then shoot up. And when inflation shoots up, then you need to hold the rates for longer. So the Jerome Powell and his entourage has two jobs. One would be stable prices, and second would be maximum employment. And this is why we have our live stream now, because yesterday the unemployment data just dropped. The unemployment data we're looking for specifically was for 4.1 to maybe lower or higher, and from there we are able to roughly gauge what Jerome Powell and his entourage may do in September. And at this point of time, ladies and gentlemen, our unemployment rate has gone higher than expected. It's gone from 4.1 over here to 4.3%. And this actually tells Jerome that the economy is suffering slightly at 4.3%. They said that this year they should end around 4 or 4.1, somewhere around here. This would be healthy range. This is a range where Jerome Powell and his team will then smile. However, at this point of time, we are at 4.3 and but when you're looking in the long-term slides, when you're looking at the longer-term data, you realize 4.3 is actually not that bad. So what we are saying is, depending on what's going to happen, but the more likely outcome is that once again they will follow their June projection. This is their June projection, and they are expecting one rate cut in this year from 5.33 today to 5.1. Next year they are expecting it to come down to 4.1. And then in 2026, they're expecting their federal funds rate to come down to 3.1. But we're in Singapore today. All these numbers don't mean too much to us unless we bring it back to our Singaporean context. So if we bring it back to our Singaporean context, this is where we come up with our chart to be able to tell you roughly where interest rates are likely to be based on the correlation. Okay, so if we say by the end of this year, what would our SORA be, right? Our SORA currently is about 3.63, 3.65. It's hovering around here. It's going to be reduced to 3.49 thereabout as the effective federal funds rate gets cut. And as it gets cut from this year to the next, we are expecting SORA to reach 2.81. So on and so forth. However, projections get less and less reliable as we progress through time. So let's look at these numbers first. Okay. So what I think is, Shem, if you are given a choice, you have $1 million loan, okay? You have the choice of getting the 3-month SORA plus 0.4 versus if you get fixed rate of 2.83. Which would you choose for this year?
I think this is simple arithmetic. Yeah, I would still choose fixed because, if you add the SORA 3.49 plus 0.5, what does that give you? That still gives you about 3.999, right?
3.99. Yeah.
3.99. That's about 4%, right? And fixed is you said what, 2.83, is it?
2.83.
So it's clearly fixed is the winner.
Okay. How about next year, 2025? Let's talk about that.
Okay. Plus 0.05 again?
Plus 0.04.
Plus 0.04. So 2.81 plus 0.04, that gives you 3.2. So your 2.83 is still the winner. So you will have 2 years in a row, 2024 and 2025, fixed rates being a winner.
Correct. So that being said, I believe from there we might know what is likely to be the case. And once again, ladies and gentlemen, this is a projection based on projection. Therefore, we have a 63% confidence. At the end of the day, we want you guys to be having the advantage to be able to choose the right rates. However, these are all projections, and we just want to be able to look at where smart money is, where the better alternative is. Our job is to help you save as much money as humanly possible. All right. So that's it, ladies and gentlemen. Do you guys have any questions that you would like to pose to us? Okay. Don't have questions so far. It's okay, which means we did an okay job. While there is no questions, let me just wait for a while and see whether there are any questions that will roll in. Otherwise, we have slides that we have prepared for you. Okay, so questions coming once, questions going twice, 3 times, 4 times. Okay, maybe next time. All right. So today we want to talk a little bit about the strategy a little bit, so that most of you know what exactly you should do with your mortgage. For example, in a situation where you buy a building under construction. Oh, STHER. Okay. How do I get a consult? Is it free? Okay. For you guys, whenever you want to have a consultation, of course, you all don't need to know everything. You all just got to click on the link that is in our description. Okay, there is a sign up link over there. It's at bit.ly/SG Home Loan. I'm going to copy the link and I'm going to put it in the chat so that everyone will be able to see. One moment, copy and paste. There we go. So that is the link. Anyone who would like to sign up can sign up over there. All right. Yeah. Okay. So coming back to the building under construction timeline. Okay. So if you're here, right, what you might want to do. Okay. So Sham, I'm gonna do this. You're gonna do the next one later. Okay. So
Yep,
what you
sure.
might want to do over here, right, for properties that have building under construction, those places that you bought that have not yet been fully built. All right. What you might want to do is first get a loan, and then after that, you might want to consider repricing. The reason why you might want to consider repricing, right, is because, right, for this property, right, there is usually undispersed loan. So undispersed loan is the loan that has not been fully dispersed yet. And when it is not dispersed and you leave the bank, they will charge you a penalty. So in this circumstance, likely what you might be doing is to reprice. But of course, check with us through the link, because at the end of the day, sometimes your repricing rates can be really, really bad. Shem, do you have any experience of this?
Yes, as with all the audience in this call, I'm also a
Mm,
homeowner. And as a homeowner, I go through this process many times because I bought and sold houses and buy again and so on. And specifically to this building under construction,
mm,
um, the when you have a fixed loan of 2 years,
mm,
what that means is that you have the opportunity to go reprice. And some banks, as I said earlier on, allow you to reprice after 12 months. But you can reprice at the end of the 24 months. And by repricing, you're basically saying, hey, you know what? I don't want your SORA rates plus 0.4, but plus whatever the number is. We went through the simulation just now. And we
correct.
know that 2.83 will still be better than the SORA plus. So and SORA, and that becomes whatever interest rate that you pay after the second year is the day after rates, right? We said the day
Mm,
after rates sucks. Then this gives you the opportunity to reprice, and I think
correct.
it's a very good program to do that.
Correct. And repricing rates usually you get directly from your bank. So they will be able to tell you what rates they can offer you. Whereas, right, for us, what we do also would be to refinance your loan. So when we're refinancing, we are looking at how many banks, Sham?
10 banks.
10
Unbeatable,
banks.
yeah, Unbeatable has 10 banks in our stable, and we will shop for you. That's our job. We'll do the shopping for you, and we look for the best promotional deals that there are in the market at that moment to help you do refinancing and help you switch from one bank to the next after the end of your second year.
All right, wonderful. And one thing about us, right, is that when you are looking at this, right, you are actually getting a little bit of an advantage, because you're looking at getting us to help you negotiate. Our bankers know that we are very, very, very pragmatic people. We only go for the ones with the better rates. If you're a banker and you give us lousy rates, we're probably not gonna take your loan. But one other thing that I like to share, right, is that in our company, right, we do not mind recommending like things like not doing anything depending on your circumstance, depending on your what you intend to do. If you are intending to sell away your property, then a lot of things go out of the window, and then the advice becomes a lot more customized, especially when you're going to sell off everything. Recommending a repricing or a refinancing may be a bad idea. The the exit may be the only place where we're telling you guys, hey, maybe it's okay to face the day after rates. And there are also packages in the market that tells you guys, hey, if you want to sell off this property, you can sell it without fees. And I think because of that, like um, the resale market and the repricing market then blends together, and the strategy is usually quite similar, right? Once again, over here, right? We always highlight, after you refinance, you may want to do a repricing. After you, the reason why is because there is the clawbacks that we worry about. One of the few things that we always stress is any form of penalties. We do our best to avoid. All right. So I think that being said, I think no questions so far. I think we've done a good quick sharing. Sham, do you have anything else to add?
Yeah, I just want to talk a little bit about the clawback.
All right.
By the very word clawback,
Mm,
it's like this: you have a claw, right? You claw it back. Claw it back means you take back.
mm,
Banks will take back whatever money that they have subsidized you if you did not fulfill the period of time that you're supposed to fulfill at the point when you sign the contract with them, when you took the loan from them, right? One of which is, for example, is a two-year lock-in, and based on that, they have given you some subsidies, let's say legal subsidies or whatever the case may be. And if you try to get out of the contract, they will just say, "Hey, you know what? I've already subsidized you before. I'm going to take that back," or something like that. Yeah. So I think it's very important that the homeowners, before they do any repricing or refinancing, they need to start looking at the contracts and the loan contracts with the banks and know what the exposures are. And this is where Ethan and I come in. We come in because we help you look at your contracts, and we will help you identify where are the different fine prints that says there's a 1.5% penalty if you do a prepayment ahead of time or something like that. So we will go through with the fine tooth comb to help you identify where all these items are and help you avoid having to incur expenses of this nature.
wonderful. So, I think that sums up quite a bit of what we do. I think today was a nice get to know you guys and session and our first webinar. So thank you all for showing up and sticking with us through the end. If you guys like to engage us, reach out to us through the link below. We are here to help, and we can't spell unbeatable without you. All right. That being said, thank you all once again. See y'all. Have a nice rest of the evening. Bye bye.
Bye bye.